Hello everyone, welcome to the channel where as always we provide you with that education and that information. Now in today's video we're going to cover some very key life insurance terms that you need to know. Now there are a lot of terms in life insurance, but the ones I'm going to cover today are key terms that you need to understand as a consumer. So let's dive right into it, all right? So the first term is insurer. An insurer is the insurance company. So it's the insurance company that's going to insure the person for life insurance. So that's what the insurer is, okay? So very simple. The next is the insured. The insured is the person that's life is being insured. So that person is the one that has to answer health questions, that they have to check to see if they had any issues before. They have to make sure that this person live a very healthy lifestyle. They're not a very risky person. So all the risks that the insurer, which is the insurance company, has to take is going to be on the insured. Okay, so that's the insured. The next is the policy owner. This is the person that owns the policy. It could be the same person as the insured, but it also could be another person. They don't have to be the same person. But this person owns the policy and controls the policy and have policy rights and decisions on the policy. They can choose beneficiary, they can borrow against the policy, so they have the owner's rights, okay? Next is the payer. This is the person that, or entity, that's going to pay for the premium. That's going to pay the premium so that the insurance contract could be enforced. So this person pays whether it's monthly, quarterly, semi-annually, or annually. This person pays, okay? And again, it doesn't have to be the same as the policy owner, but it can be, all right? The next person is the beneficiary. The beneficiary is the person that is going to benefit, that's going to get the death benefit. So when the insured dies, the beneficiary will get the money that the life insurance company is going to pay out, which is the insurer, right? All right, so next is a producer. A producer is a person that negotiates and solicits life insurance products. They come in the form of an agent, a broker, or a consultant. An agent represents the company, which is the insurance company. An agent represents an insurance company. A broker represents a client, and a consultant represents either a company or a client. Okay? So, producer. Next is the death benefit, which we just already touched on. The death benefit, or sometimes called the face amount. That's the amount that's going to be paid out when the insured dies. So when the insured dies, a death benefit is going to be paid out to the chosen beneficiary of the policy owner. This amount is also sometimes referred to face amount of the policy. Okay? Underwriting. Underwriting is the risk assessment. So that's the period that the insurer is going to take to make sure that this risk is something that they want to take on. So during the underwriting process, they're checking consumer reports. They're asking questions, of course, during the application phase. Those questions are underwriting questions as well. They're checking health conditions. They do exams, and so forth or so on. And then at the end of underwriting, they decide, okay, this person is too risky, or they're a good risk, we'll take them on, but we're going to put them in this risk category. So therefore, they'll have to pay this particular premium. So whether it's a really great health risk, pretty healthy risk, average, or substandard. So there's different risk class. So the underwriting process will determine that. Okay. Next. Premium. Premium is the amount that you pay as a policy owner or payer to the policy in order for the insurance contract to be valid. That is the only thing you have to do once the policy is in place. Okay? And I'm going to mention another term that I don't have on the board here. But this is what you have to do. Once that policy is in place, insurance contracts are unilateral by nature. That means only the insurance company has to do everything. Okay? Only thing you have to do is pay your premium. So later on, if you weren't a smoker, okay? And I'm not telling people to go do this, but I'm just telling you how it works. Later on, if you came on board and you weren't a smoker, but 6 months, a year later, you became a smoker, they cannot stop the contract now after that, okay? They took on the risk, they can't change it anymore. They have to pay out if something happened, even if you became a smoker or you started doing activities that you said you weren't doing before or you didn't intend. So let's say you never did skydiving, and 4 years into the policy you start doing skydiving and die. They still have to pay it out, okay? So that's how it works. It's unilateral by nature. The only thing you must do is pay a premium and you're good, all right? So next is a conditional receipt. A conditional receipt is when during the application process, once you make a payment, once you make a premium payment, you are insured, you're covered. So if you die the next day, your beneficiary that you chose will get that. So you get a conditional receipt saying that. This is happening meanwhile the underwriting process is being taken care of, place. So if something happened before underwriting is complete and you die, your beneficiary will get a payout. It's conditional because it doesn't make, just because you get a receipt, because you make a premium, it doesn't mean that they have to go through with approving a contract. When underwriting is finished, if they deem that you're too risky, they will not issue a contract and they'll give you back any premium that you pay. So that's how the conditional receipt works. Next is the MIB. It does not mean Men in Black. It means Medical Information Bureau. It's a group of insurance companies that has formed this organization where they have all types of life insurance information on people, on health and consumer reporting and all that kind of stuff. So do not lie on an insurance application. They will find out, okay? They'll pull records and they'll see, you know, whether you've been denied for insurance before for whatever reason, whether you commit anything. It's all on the MIB, the Medical Information Bureau. So it's consumer reporting and it has health information and all that there. So don't lie. So if you got denied before because you had bad health, don't lie about it because they're going to find out from the MIB, okay? Next, the Incontestable Clause. The Incontestable Clause states that after 2 years, they cannot contest anything, okay? So, if they have up to 2 years. So if anything that you said on that report and when you were filling out your application that was not true or was not accurate, okay? If they found out after 2 years, they still have to pay the death benefit. They can make adjustments. For example, if you lied about your age, they cannot now cancel the policy because they found out that you lied about your age after 2 years. And if you die, they would have to pay out the death benefit, but they can make adjustments based on what your real age is, all right? So the incontestability clause, they cannot contest after 2 years. They have up to 2 years to make sure everything is good before they can deny anything, okay? Next is cash value. The cash value is the amount that's built up in a permanent life insurance contract based on premiums paid as well as interest earned. Now, if you decide at some point you decide that you wanted to surrender your policy and you didn't want to continue with this policy, whatever the cash value of that policy is worth, that is what you would get paid. Okay? So that's cash value. Policy loans are loans that you can actually withdraw or borrow against your policy. There's a couple ways you could do it. You could either withdraw from your cash value or you can borrow against it. borrow against it is definitely the way to go. And I explain why in other videos. Okay, so that's policy loans. Dividends is what you get back in a mutual company. There's two types of life insurance companies. There are the stock company, which are owned by shareholders, and just like any other stock company on the stock exchange, they have shareholders, and you can buy. It's traded on the stock market. So you have stock companies, and you have what's called mutual companies, which are owned by policy owners. So as a policy owner, you can get dividends for profit. So after everything has been paid off and every money has been allocated, whatever profit is left, they pay you as a policy owner in the form of dividends. Okay, so that's what dividends are in life insurance. Okay, next are riders. Riders are anything that you can add on to your policy to make it better. Some examples are like extended term rider, child rider. You can add waiver of premium rider, accelerated death benefit rider, or terminal illness rider. You can add, what else? Few of them are out there. But that's what it is. Basically, you add on to the policy to make the policy better. And those are some of the more important ones that I just explained. Accidental death rider is another one I thought of. But yeah, but that's it. But those are the terms that I have today. Like I said, these are very important terms that you need to know as a consumer, so you understand life insurance and understand how it works for you. As always, if you find the information valuable, please go ahead and like the video. It doesn't cost you to like it. And place a comment if you have a comment, or if you have a question of anything that you'd like me to answer for you. I'll be able to do that for you. And if you haven't already done so, make sure you subscribe to the channel and hit the notification bell so that every time I drop a video, you're notified. And I usually drop a video mostly twice a week. So you'll be first to get the information, all right? So until next time, I'll talk to you guys soon.